Is this the most anticipated video of this entire course? Probably, right? It's going to be the most fun, and it's basically the most crucial because it's where we put everything together, and it is creating our edge in the market. Not only am I going to show you my strategy that I have step by step, but you can also tweak it to make your own strategy if you would like. But if you just like to copy my strategy, then by all means you can do so. With this, I'm going to grab it up right now, and I'll drag it over here so that we can take a look at it. I will do this so we can see it a little bit nicer. And yeah, basically this is my strategy broken down step by step into all of these steps that I need to see the market do in my favor in order to then allow me to press enter on a trade. So as we can see, right, we have London session. That's of course the session time that I'm trading, opening at 8 a.m. London time, and I'm trading the GBP USD pair. That is my currency pair of choice. So you, of course, as we did last lesson in the trading plan lesson, you would have been picking your currency pair or your stock, whatever it may be that you choose to be trading. I'm just written it out here. So all we're going to do is we're going to run through this. We're going to go step by step, actually executing a trade. You'll be able to see how I execute a trade. We'll break it down, and then you can either copy all of this or tweak it to make it suit your own style. So step one, of course, finding a draw on liquidity for the bias, as well as checking news for high impact news or bank holidays, right? So of course, as we learned, we would go into Forex Factory. We would check news if there was any high impact news or if there was a bank holiday. There's some shit in my way here. But if there was a bank holiday or some high impact news that could affect our trading, then of course that would affect our first step, and we may or may not be able to trade. For this example though, I know that there is no news and I'm all good to be trading. So for step one, I would be looking to find a daily draw on liquidity for our bias. So we did that not too many lessons ago, and we should all be pretty good at that now, having done some homework around it. We are going to be looking at trading this Monday. So of course from that, we would take the Friday candle, look how it reacts with the Thursday candle. We see we get a close below that daily low, allowing us to target a daily draw on liquidity to the downside. We would look for a bearish draw on liquidity, and we can add that in just like so. Step one is already done. Nice and simple. Step two, what we're going to do here is I'm going to mark out fair value gaps and liquidity points within the market on the 5-minute, 15-minute, 30-minute, and hourly chart. Now, I don't have to put it on every single one of those time frames. I'll show you exactly what I mean by that. Basically, those are the 4 chart times that I'm using to mark out my liquidity and my fair value gaps, okay? So I'm not trying to mark out liquidity or fair value gaps on the 4-hour, on the 3-minute, anything like that, you know? I'm just looking at these 4 based on my strategy. So of course, we'll jump onto the hourly time frame to start. Obviously, I have to mark out the London session open, which comes all the way over here. So let me just put that line there like so. Play price forward until then, and this is what I'm left with. So starting on the hourly time frame, basically at this point I just want to mark up a few areas that price could potentially move into before dumping in the direction that I want to see the chart go. When I'm marking up these points, do I want to mark up any fair value gaps that are below price or any liquidity below current price? No, because those will be my eventual targets. I'm not looking to go longer. If you're looking to go longer, you would mark up the lows. If you're looking to go short, you would mark up the highs, right? So you basically want to see an opposite happen before the move in your direction. So we have an hourly fair value gap up here. We have an hourly high over here as well. I can mark those as a couple of potential areas price could move into. I would move lower onto the 30-minute chart, see if there's anything different up here. Basically the same sort of area. 15-minute chart again, same sort of area. We do have a 15-minute high get put in here, so I make that just a different color, just so I know that it's not as strong a liquidity point as the hourly. And then finally onto the 5-minute chart, it's basically the same area that we would have a sweep point. There is a little fair value gap in here, but we just closed past that. So basically, before the market opens, this is what my chart is going to be looking like. I, of course, will show this. Again, step 2, marking out the fair value gaps and liquidity points. This is what we'll be looking like, right? We then want to wait for price to reach those areas. So I can play price forward a little bit. I'll get rid of this session open, but we can tell the session is now open. We are now in London session, and then we'll play price forward a little bit until one of these areas get hit, which as we can see was this high that we had marked up on the 5-minute and on the 15-minute. Bringing our strategy back over, step 3 after one of these areas was hit is to wait for a 1-minute break of structure in the direction of our daily bias, today of course being bearish. So we would jump down onto the 1-minute chart after one of our price points gets hit, and as we know, we are looking to target 1-minute break of structures to the downside. So obviously we would have had this at the start point, we get a new 1-minute low get put in over here, we'll just move our 1-minute break of structure until we play price forward and eventually get a push down below the 1-minute low. So of course we do get a new low here, so we need to move our line like so, continue moving it until we do get a confirmed break of structure, which as we know our rule has to be at least 0.5 pips of a break, and this one obviously is about 3 pips. So definitely confirming our break of structure to the downside. Pretty much at this point, if I get a sweep or entry into the fair value gap and the break of structure to the downside, I like to just clean up my charts by getting rid of these other areas in the market, because we're not paying too much attention to them anymore. Unless price reverses against us and invalidates a trade, then we'll look to put them back. For now though, we will move on to step 4, which is marking out the order block, the equilibrium level, and any 1-minute fair value gaps from the break of structure move. Okay, so jumping back on here, we can see of course we have that break of structure to the downside. We do have a 1-minute fair value gap back up in here. We have the order block back up in here as well that we can mark there. Obviously we don't know if there's going to be a fair value gap get put in here, plus the equilibrium is not yet completed because this high does not yet have a low, so we're not exactly sure where the EQ level is. We will have to be patient and wait for another candle. This one is a up candle, giving us that low and creating that equilibrium level in there, as well as forming a 1-minute fair value gap just across that little point there. Now step 4 is not complete yet. Price must first retrace into one of these areas. Obviously these are our tools that we use as a retracement. This is helping us to confirm that the entry is still valid. I'll go over invalid entries in a little bit after we continue running through this. So we have our price points and the areas that price could retrace into. At this point, basically what I want to do is I want to get my short position for today, and I am placing my stops 2 pips below or above the order block. So as we can see, I put it on the highest point of this setup, the highest point going past the sweep, arranging it until this says 2. That is of course the amount of pips that we are risking within this area. Just dragging this out of the way, pulling it down here, sending this down here just for now. But then by having this here, I can prepare myself to determine what my risk is going to be. So of course, I'm estimating that if price retraces into here and rejects, we could get an entry around this area, which would be around a 12 pip risk. So I'll be covering lot sizes in another video, but basically with that being 12, I can then prepare my risk as a 12 pip position, adjust my lot size accordingly, and then be prepared to enter into the market. So I also like to apply my stop loss as well, which we'll go over in actually executing trades a little later in this course. But by placing the stop loss there, I'm not going to accidentally buy and it'll fill me, because that has actually happened a couple of times. I won't lie. I've gone to sell the market, but I press buy and then it fills you into a buy position. But by placing your stop loss basically at this point and you try and buy from this market, it doesn't let you. It says it fails because you can't put your stop loss above where you want to enter into the market for a long position, and then obviously flip that for a short. But basically we are ready here. We have 12 pips estimated to be our entry. We are waiting for price to retrace into one of our areas. This area looks very good because we have the equilibrium level and the fair value gap and the break of structure line all within this one little area. So of course that is potentially a high probable area price fills and rejects off of. So we play price forward a little bit more and we wait to see how we get a reaction. We can see price fills into that fair value gap, also tapping the equilibrium level and then giving us a strong bearish rejection to the downside, which is of course step number 5. Once price gives a strong, it has to be a strong rejection. It can't just be like a little, it looks very indecisive. That's why we learned about our bearish and bullish engulfing candles earlier in the course, and then as well the doji candles. So strong rejection, oh, that should say off one of those areas in the direction of our daily bias, and then we are entering a position. So as we can see, this candle did start filling, rejected to the downside. It is a nice bearish engulfing candle. We would of course adjust my position while the candle is moving, so it is a bit different when we are in a live trading situation, but we'll adjust our candle while it's moving, and we will see that we'll get around a 14 pip stop loss, allowing me to then look back at my lot sizes, adjust myself to risk my 2% in 14 pips. I'll obviously cover that a little bit later, but that would be our entry. There we go. We would be entered into the market based off that. Let's say we get an entry there. Perfect. Our stop loss is placed. Our entry is covered. What is the last step to do? We have our stop loss 2 pips below the order block of the setup. Tick. Then for me, for this strategy, I'm looking to target at least a 1 to 2 risk to reward. Basically, based on the strategy, it works very good. It doesn't obviously hit every single time, but if you just drag this green little section down here, you'll see that number in the middle rapidly changing around here, and this is our risk to reward. So at the moment, the risk to reward ratio is a 2.02. I like to just press option H. I'm not actually sure if it's option on the PC because I don't have one, but put in a dotted line. You can just get up a dotted line like one of these, right, and just add it yourself. Anyway, put a dotted line around the two risk to reward ratio area. That's where we're obviously going to be targeting, and we don't want to be targeting 1 minute liquidity. I like to move on to the 15 minute, at least the 5 minute even, and then basically where that 1 to 2 risk to reward is, I take a look at past price action, and as we can see, there is some resting liquidity at this 15-minute low just here. So this could become a target point for me, moving my target to that area, getting rid of that. This could potentially become my area of interest, being the target, and then we would play price forward, and we see that price just melts in the direction of our target and does result in a very nice win. Of course, yes, you see it moves past the target a little bit more, but that's greed. We don't want to be greedy. We are targeting what makes sense, and if the market moves there, we capitalize on it, and we are happy with what we made. I'll be covering over greed a little bit in the future anyway, so don't worry about that. But for now, that's just an example of how we actually execute the strategy. So as you can see, put the strategy over here, put the plan up there, bada bing, bada boom. There you go. So you can make a copy of this if you would like. You can write it down and copy it if you would like. Obviously, we are going to need to be practicing it. That's why we're learning about backtesting in a few lessons time. But for now, just fill this out if you would like to make your own. Copy it if you would like to trade the way that I trade. And yeah, there is, of course, a reason that we should not look to enter into a position. I don't have that written down on my strategy sheet here. But if I get rid of this, I can sort of just take you through an example. So if price was to retrace, right, we get our break of structure to the downside after sweeping the liquidity. We get the break, we mark up all of our liquidity points, our retracement points I should say. If price is to continue with candles moving up, retracing into the order block, giving a weak rejection, but then continues pushing up, and say we get a close, I'll get rid of this for now. Say we get a close past the order block. If it's little like that, I can still count that as a valid entry. I won't be too confident in the setup though. But if we get a candle that like closes a long way past it, breaks structure back to the upside as well on the 1 minute chart, then we're bullish again. Plus we're out of this setup range. We are moving past that liquidity point. That is when we should stop looking to enter into this position. I can actually take it back a little bit here. Now this is obviously not during the session time, so this would not be a valid example, but as the example, because price action moves the same, we can see, let's say that we move into a fair value gap up here. There's like a 5 minute fair value gap here or something. We move into that. We then target a 1 minute break of structure to the downside, right? Now we would be waiting for a fair value gap like so to form. This could be a retracement level. We would want to see price move back up into that retracement area like it has done. We obviously also have our order block that I would place up there like so. We want to see price retrace as it has, and then as we can look back here, step 5 is once we get a strong rejection off of those areas in the direction of our bearish bias for this example, then we can enter. So that's why we don't enter, like I said, on a touch of the equilibrium level or anything like that. As you can see, we can draw out the EQ level. It gets touched. We don't enter just off the touch. We want to see price reject and basically have a reaction from those areas, right? Because it will confirm price it is likely to go our way, right? So at this point, we wouldn't be entered into the market. We'd be patient. We'd wait one more candle. We can see this fair value gap gets invalidated. We'd ignore that now. The order block gets filled. We are still waiting for a rejection to the downside for the setup, but price continues higher. At this point, the setup is invalid. We've moved too far past. We've broken structure back to the upside. We're past the order block. Even if you wanted to wait one more candle, you still don't get that move back to the downside. So this would become an example of an invalid trade setup. So that's why we have to be patient, and that's why we have to make sure that we are following the rules of our strategy to perfection, marking out all of our retracement tools, and then waiting for rejections off of those areas. Don't just enter off the touch of the equilibrium level just because it's within a fair value gap and at the breaker structure line. Normally, this is very, very good area to see price come back into and then bounce down again. At this example, price didn't do that and we continued higher. So if you entered, you would have been taking a stupid loss. It's a loss that you shouldn't be taking. And yeah, you're annoyed with yourself. And then you can see that, by waiting, price continued higher and then eventually gave the setup that we got over here, where we could have capitalized on a nice risk to reward ratio. I think it was 2.15, something like that. But yeah, invalid trade setup. Let me take this out of replay mode. Invalid trade setup, valid trade setup. This one wins, this one loses. Do not be entering on the invalid trade setups. Make sure that we are capitalizing on our valid setups using, of course, our strategy, following this to perfection. All right, so I hope that made sense. It should have made sense. You should be able to copy down that strategy. You can make it your own if you would like. That was just an example, obviously, of a winning trade. It does not win every single time, that is for sure. But if you take a look at this, actually, I'll show you this real quick. Here we go. I just took a screenshot of it. This is called the risk to reward versus the win rate. So this is basically to determine a profitable strategy. All right. On this chart, all of the red is non-profitable. You can see down the bottom based on the risk to reward and the percentage of your win rate. Okay, but let's take a look. For example, the 1 to 2 risk to reward, which is what my minimum risk to reward is. I need a win rate of 40% in order to be profitable with the 1 to 2 risk to reward. Now, this strategy is about a 40% win rate, maybe even slightly higher than that. And sometimes it's going to a 1 to 3. On the very rare occasion as well, it can go to a 1 to 4. That just determines obviously on a lot more factors, but I'm around a 1 to 2 to 3 risk to reward, meaning a 30 to 40% win rate is all that I need in order to become profitable. However, if I was to be trading a 2 to 1 risk to reward, which is really stupid, you would definitely not be wanting to trade that. So risking $100 just to make $50, right, doesn't make a lot of sense. But if you were to be risking that, you would need at least a 70% win rate on the strategy in order to be profitable. Obviously, you can make money with it. It shows it right there. But it's very, very stupid unless you have a very high win rate. But alternatively, you could have a 1 to 5 risk to reward, and you'd only need to win 20% of your trades in order to become profitable within the market, right? Because every time you risk, you are risking 1. Every time you lose, you are only risking 1. Make that 1%, right? Let's keep the math easy. On every trade, you're risking 1%. That is the first number there, the 1. Okay? Then, every time you win, you're making 5 times that risk. So your 1% risk for the day will be a 5% winner. Okay? So you'll be making 5% every time you win and losing 1% only every time that you lose. That's why a risk to reward is so important. But you also got to make sure that it ties in with the win rate. You can see that there's a couple of orange squares in here as well. They're obviously a little bit rarer, but we can see that those mean break even. So of course, with a 1 to 1 risk to reward, you're risking 1% to either make 1% or lose 1%. Then at 50% win rate, that is where you are break even. Obviously, you're winning as much as you lose, so the price stays the same. And then you would need a minimum of a 60% win rate in order to be making money and capitalizing on the market. So don't get discouraged if you notice that your win rate is only within the 30-40% range. As long as your targets are 1 to 2s, 1 to 3s, then that's absolutely fine. That is profitable trading. Obviously, if you have a 1 to 2 risk to reward and you've got like a 60% win rate, that's even better because you're profitable by a larger margin. Now, I cover this in a couple lessons time, but basically when we're backtesting, we're going to notice that there will be some months where we are making profit, some months where we're break even, and some months where we're losing profit. That all comes down to just whatever the market is doing at the time. You are never going to have consistently the exact same months, the exact same weeks. I'll cover all this in the backtesting side of things, but yeah, it'll be varied the entire time. All that you need to know is that based on a larger picture, your win rate will be suitable to your risk to reward, and that way you become profitable. So take a screenshot of that if you want. Basically, I just search risk to reward profitability chart. There's a bunch of them. Take a look at them, pay attention to them. Don't get discouraged with a lower win rate, because as long as the risk to reward is correct, you can still be making money. All right, that's the strategy. That is how we execute it. Obviously, this is just an example day of a winning trade. We do not take wins every single day. So we will learn a lot more about how we actually handle our emotions when we are taking winners and losers in future lessons. But next, I believe we are covering the take loss, the stop loss, and the take profit areas. So going over them just a bit more, just so they make a bit more sense. And then obviously you apply that to the executing strategy that I've just shown. And basically you put it all together, bada bing, bada boom. You've got an edge over the market, and we're ready to start taking trades. But not just yet. I do need to explain where you should start first. That's coming soon. Anyway, see you in the next one.